What's up, people? Welcome back to Invest with T Claus. My name is Tevi, and this channel is dedicated to my investment journey, along with coverage on crypto, Tesla, Neo, Virgin Galactic, and ChargePoint. Come for the information and stay for the perspective. So today's topic is Tesla, but we can't ignore how volatile this week has been overall. Markets pulled back briefly on the news that the Fed was holding rates steady, only to then reverse higher on the back of above expectation results from tech earnings by Meta, Apple, and Amazon. Meta stole the show by announcing that they would start paying dividends, and that is a first in the company's history. Between that and the stronger than expected jobs report on Friday, the market not only made a comeback, but the SP 500 posted yet another brand new all-time high. It's crazy, but I did tell you to expect this as the year got going. Now, for Tesla specifically, we are down 24.38% year to date, with a big portion of those losses coming post-earning call last week. But with all the good news flying around this week, they too managed to close the week with a gain of 2.54%. So in today's video, I'll go over the main takeaways from the earning call and what turned sentiment bearish, then touch on the latest Tesla recall impacting millions of vehicles, followed by a brief look at analyst ratings, and I'll leave you with some closing thoughts. As always, this is not to be taken as financial advice. I am not a financial advisor. This is my personal approach to investing and a thought process behind it. I'd recommend watching all the way through so that you don't miss out on any pertinent information I'll be sharing. Drop this video an early like if you haven't already, and smash that subscribe button. Those are two easy ways to show your support to the channel and help it grow if you appreciate the content. All right, let's get into it. If you follow Tesla as long as I have, you know that a sell-off post-earning call or in the month following the earning call happens more oftentimes than not. Median returns, as you can see on the screen here, support that statement, and it's just what it is. So what did we learn during the earning call? Let's start with the good news. First off, the Model Y became the best-selling vehicle in the world, not just for EVs, right? But the entire world out of any category, with 1.2 million cars sold. Their energy generation and storage business doubled on a year-over-year basis, and profit nearly quadrupled last year. Total vehicle delivery crossed just over 1.8 million units. Meanwhile, installed production capacity is now at 2,350,000 units across all models and factories that Tesla currently owns. One thing to note here is that the Cybertruck installed capacity is expected to ramp and double this year. Elon and team did offer a bit more insight on their next generation car and stated during the Q&A portion of the call that they expect this new car to go on sale in Q4 2025. The interesting part here, which you won't see in the investor deck, is the fact that they emphasize how much more advanced this platform will be and the innovative manufacturing equipment being created by Tesla to further decrease the cost of manufacturing and increase productivity. Ultimately, Tesla increased its cash position last year and is now sitting at $29.1 billion in cash, which they stated is more than sufficient to continue growing and fund the efforts around AI, robotics, FSD software, and all efforts surrounding the automotive and energy side of the business. Now, we do need to talk about the not so great news that led to the stock sell-off. It's all centered around the forward guidance and this statement here. And I quote, "In 2024, our vehicle volume growth rate may be notably lower than the growth rate achieved in 2023, as our team works on the launch of the next generation vehicle at Gigafactory, Texas." End of quote. This, of course, has to do with one, focusing resources on ramping Cybertruck manufacturing, and two, as mentioned earlier, creating the machines needed to build their new vehicle platform. In the same way that Tesla introduced gigacasting, which was a first for the industry, there is some never before seen technology that will be coming with this next gen platform. But as far as the market is concerned, if growth is slowing this year, it means lower revenue and shrinking margins. Therefore, valuation for Tesla has to be adjusted, hence the pullback near term, and that's the logic. The other item pressuring the stock is this recall, right? Now, if you haven't heard about the latest Tesla recall, you likely will in the coming days. The Wall Street Journal reported that Tesla is recalling 2 million vehicles, right? It's the largest to date, and a few other publications jumped on the bandwagon with similar headlines, making it seem like this is tied to the autopilot feature. What they're not telling you, and you will likely not realize until you read through those articles, is that this is strictly an over-the-air software update. So the issue here pertains to the font size of the brake, park, and anti-lock braking system, visual warning indicator, which in this case is smaller than the 3.2 millimeter or 1/8 of an inch required by the NHTSA regulation. The concern is that drivers may not notice the characters in the warning light when it's lit, since the font size is smaller than required per the regulation. The software update was already pushed out by Tesla, and all impacted cars and vehicles are being corrected. The main reason I'm telling you this is, one, so you don't panic once you start seeing the negative narrative being pushed around, and two, the downward pressure this is adding to the stock is an opportunity to add for those of us interested in continuing to DCA into Tesla. Something to keep in mind. As far as the stock ratings are concerned, the beauty of waiting a week or so post-earning call before diving into the details is that most, if not all, the analyst ratings covering the stock have been updated. Given the slow in growth guidance provided, the overall consensus rating did shift and is now listed as a hold. This is made up of 34 ratings with the following breakdown. We have 12 buy ratings, 16 hold ratings, and 6 sell ratings. And I gotta say, it's somewhat entertaining to take a look at how much delta there is between the top end of the range and the lower end of the range. And what I mean by that is the high end of the range for Tesla comes in at $345. Meanwhile, the low end is at $23.53. And no, you didn't hear me wrong or read that wrong. This is such a polarizing stock that even the valuation has to be extreme on both ends. So it is what it is. The average consensus price target sits at $220.98. This implies an increase of 17.60% from the current level and nearly double the returns when we reach the top end of the current range. And so what do I make of all of this? It's no secret that I'm pretty bullish when it comes to Tesla. I drive the car and I bought the mug so I can figuratively and literally drink the Kool-Aid, right? So take what I say with a grain of salt. Again, bullish point of view here. But I would say that despite the fact that I believe that Tesla is unmatched and will further pull away from the competition as we get into 2025, and ultimately will be completely out of reach by the competition when their mass market, fully autonomous, capable car is launched in late 2025, it's undeniable that Tesla has hit a rough patch near term. So taking a look at the technical charts, and you can see here that the stock is actually oversold. It went deep into oversold territory directly post-earning call. That's the huge drop you're seeing here with RSI at 17.43%. And that's before bouncing back and closing the week at $187.15 with an RSI of 27.23. This is still considered oversold. Anything under 30 actually is. What's a bit more concerning for the near-term price action is this death cross here we just experienced at the close of January. Simply put, this is a technical term signifying a trend reversal with momentum shifting to the downside. With the overall market now at an all-time high, we're basically just waiting for a catalyst to cause market participants to take profit en masse. If, like me, you're not too concerned about the immediate future, so the next month or two, I'd start taking advantage of this lower price on Tesla. Anything under 200, in my opinion, offers good upside potential. That's why I bought 2 more shares to help me continue building my position. Slow and steady wins the race. That's how I think about it. Now, with that said, if you're looking to get the best deal for your entry point, it would be worth waiting for a full market pullback before jumping in. I do have to say that the risk there is that Tesla could resume its uptrend with the rest of the market still trending down. That has happened before, so be mindful there. And so the last thing I will say is this. If you do decide to DCA, remember that Tesla isn't going bankrupt anytime soon, right? So a lower price truly means a better valuation and therefore a better deal for investors. So the bottom line, and ultimately my take on Tesla, is that in the next couple of years, Tesla will formally launch a fully autonomous car and will officially be recognized as a technology and AI company. And when that happens, the next growth cycle for Tesla will begin. Personally, I'm packing my portfolio now before that happens. But on that note, that is it for me today. If you found value in my content, click the like button and share with others who you think could also benefit from it. For my newcomers, subscribe. It's free. And don't forget to ring the notification bell so that you too can stay in the know. I'll be back on Sunday for my weekly video. Till then, you can keep up with me here on Twitter for crypto and NFT related news. Thank you for watching. Stay humble, hustle hard, and I'll see you in the next one.